Welcome back, ladies and gentlemen, and I wish this title was a conspiracy theory or something, but it is absolutely not. This is something that I found recently, and if you dig deeper into the law and where it came from and what was proposed originally, you see that the middle class is next on this. So basically, what we got here is Washington State has proposed legislature for a capital gains tax, and we'll get into what was actually proposed originally first, to get some context on this title. But anyways, the measure imposes a 7% tax on the sale of bonds and stocks. So if you guys pulled up to the video yesterday, and it's on assets in excess of $250,000, so that's profit. Okay, so if you invested $1 million and you made a 25% return, that $250,000 in first dollar, that would be taxed at that 7%. So everything else is exempt. All right, let's move down here to what else is exempt, and we're going to talk about just some unintended consequences. So the tax exemptions include all for real estate, retirement accounts, livestock, agricultural land, which we've been seeing Bill Gates buy up, family-owned small businesses, and more. So what are we going to see more of, right? When we think about the tax code, we have to think about incentives and disincentives, right? The rich didn't get there by being dummies. They got there by following the tax codes, by not giving the government their money, by keeping their money, by investing their money and getting returns on it. So this is what we're going to see a lot more of. We're going to see more real estate buying. We're also seeing first-time home buyer credits. I think there was a $25,000 first-time home buyer credit. Let's check that out. So we look at this down payment toward equity act that's being proposed. I'm not sure if this is passed yet, but it basically would give $25,000 to first-time home buyers, and they're defined as people who have not owned a home in the prior 3 years and who are first-generation home buyers. So that is going to be another thing that's going to drive up home prices. So we already see that the average home price over here is $714,000 in Seattle, $381,000 in Washington as a whole. So let's get back over to this. Basically, what I wanted to show you guys is that they're incentivizing real estate sales. So what are these rich people going to do with their money there? Well, besides the option of leaving the state and going to another state that has no state taxes, they could go into some real estate, right? They could start buying up these properties. They could get all of these different tax benefits like depreciation and all the other tax benefits that come with real estate, such as not having to pay this tax, 1031 exchanges, and all those things. But that's probably not what you came in here for. That's not what you came and clicked on this video for. Look, this is Washington.gov. This is essentially what was originally proposed, all right, by Jay Inslee and his crew over there. So originally proposed was you would be required to pay capital gains tax on any taxable capital gains that exceed $25,000 for individuals who are not joint filers and $50,000 for individuals who are filing jointly. So essentially, if you're an individual like me and you put in, let's say $100,000, which I would not consider that to be a wealthy individual in Seattle. I mean, look at the average home price in Seattle. It's $381,000. You can afford about, in Washington in general, you can afford about a fourth of a house. In Seattle, you can't even afford a sixth of a house there. So I wouldn't consider you wealthy if you put in $100,000 into the stock market, but you would be taxed on this. So essentially, they're coming after the middle class. If you look at this, like, unless you're either just completely blind or you're in love with taxes, this obviously is coming after the middle class. And I'm not sure exactly what happened between this proposal and what actually got passed. But essentially, they targeted it at the wealthy. But I would be wary of, you got to keep your eye on this as well, because they were trying to target the middle class. They were trying to target everyone. So a lot of people out there, it seems like they're alarmist when they say, just because they start taxing the wealthy, like they start a wealth tax on the wealthy, the middle class is next. Well, if you look at this, obviously the middle class was being targeted, and it ended up not being targeted at them in the end. So over here somewhere it says that this will target the 7,000 wealthiest individuals, which that's kind of a weird justification for me, just because I'm not the most pro-tax person anyways. Like if I turn on the news tomorrow and I saw that like only 7,000 people got robbed, I wouldn't cheer for that. I'd be like, okay, that sucks for those people. Why did we have to go take their money? But anyways, I guess that just makes me kind of weird like that, because I don't want to take people's money by force. You always got to look at, there's two sides of every coin, right? If we go and we start taxing the biggest stockholders, what's going to happen to the stock market? What's going to happen to people's pensions? What's going to happen to these retirement accounts? What's going to happen to investment from not just foreign investment, but also domestic investment in businesses? That's how job creation happens, is when people invest in businesses, start businesses, and start companies. So we could see another bump in real estate prices with that free $25,000 coming, with this incentive to buy into real estate here to avoid this tax. Because you have to think about it in terms of the risk curve. I mean, on the long end of the risk curve, like the most risky, you expect to get the highest return. But when you start to decrease the effective return of those riskier investments, you basically push people so that there's a short opportunity on the lower side of the risk curve. So the only way to change essentially the expected return of an investment is to change the price of it. So when the price of an investment goes up, then the expected return of it goes down. So typically, real estate is going to be a less risky investment, but it's going to be relatively less expensive when you start to tax stocks at a more high rate, because then the expected return of stocks goes down. So the only way to get the expected return of real estate to go down is for the price to go up. And if you look at this portion of the article, you see that they say it's about time that we made the tax code fair and equitable. But let me tell you why the tax code is fair and equitable. It applies the exact same way to every person, and the people who understand it, they reap the benefits of the tax code. That's why it's fair and equitable. Okay, so it's kind of like, I don't know, if we were all standing around a cow and there was somebody, they were like, hey, everybody stand wherever you want to stand. And somebody decided to stand behind the cow, and they keep on getting kicked. They keep on getting farted on. They keep on stepping in poop. And you're like, hey, it's not too bad on this end of the cow. And they're like, no, we need to make this cow fairer. It's like, the cow is fair. You're just standing on the wrong end of the cow. That's kind of how the tax code works. All right. So don't stand on the wrong end of the cow. Hopefully that made sense, and hopefully you guys liked this video. If you did, make sure you give it a thumbs up. Let me know what other topics you guys would like to hear about, what you guys think about this topic. Do you think they're going to come for your money next? I mean, I definitely do. They already tried to. But anyways, I'll see you guys in the next video.